Ever wondered how credit card interest works? Well, you're not alone. This seemingly complex concept has perplexed many, but when we break it down, it's surprisingly simple. Imagine you're at a store and you see something you want but can't afford right away. That's where credit cards come in handy. They allow you to borrow money and pay it back over time. But this convenience comes at a cost, and that cost is interest. Interest is essentially the price you pay for the privilege of borrowing. It's what keeps credit card companies in business, and if not managed wisely, it can also lead to financial challenges. Understanding how credit card interest operates is a crucial step towards better financial management. It can help you make informed decisions about when to use your card, how much to spend, and how to pay it back in a way that minimizes the cost. Stick around to demystify this seemingly complex concept. First things first, what is APR? You might have seen this term floating around in your credit card agreement or loan document. It stands for annual percentage rate. Now, let's break it down. APR isn't just a fancy acronym, it's an essential tool to understand the cost of borrowing money. It's like the price tag on your loan or credit card debt, but unlike a price tag on a t-shirt, it's not a one-time cost. It's a rate that applies to your outstanding balance every year you carry that balance. The APR combines two things: the interest rate, which is the cost of borrowing the money, and any additional charges or fees that may come with the loan or credit card. It's a more comprehensive measure than just the interest rate because it includes these other costs. Here's a practical example. Let's say you're shopping for a loan. One lender offers you a loan with an interest rate of 5%, while another lender offers a loan with an interest rate of 4%, but with a 1% fee. Both loans have the same APR of 5% because the APR includes both the interest rate and the fee. This is why APR is such an important figure. It gives you a way to compare loans or credit cards on an equal footing, taking into account both the interest rate and any fees or additional charges. So when you're shopping around, don't just look at the interest rate. Look at the APR. It's a more accurate measure of the total cost of borrowing. Remember, APR is a yearly figure. That means it represents the cost of borrowing money over a whole year. If you pay off your balance before a year is up, you won't pay the full APR. But if you carry a balance from year to year, the APR will apply to that balance every year. So to put it simply, APR is the total cost of borrowing money on an annual basis. It's like the price tag on your loan or credit card debt. And just like you'd shop around for the best price on a t-shirt, you should shop around for the best APR when you're borrowing money. Now that we know what APR is, did you know there are different types of APR? Yes, indeed. Let's dive into the three main types. First on our list is purchase APR. This is the rate you'll be charged if you use your credit card for everyday purchases and don't pay off your balance in full each month. Next up, we have balance transfer APR. This is the interest rate applied when you transfer a balance from one credit card to another. It's often used as a strategy to pay off high-interest debt. Lastly, there's cash advance APR. This is the interest rate applied when you use your credit card to withdraw cash. It's usually the highest rate among the three and begins accruing immediately, unlike the others. So, whether you're buying groceries, transferring balances, or withdrawing cash, there's a different APR for each. Each type of APR applies to a different aspect of your credit card usage. But how do lenders calculate APR? Well, the calculation of the annual percentage rate, APR, is a multi-step process. Let's break it down. First, the lender determines the periodic interest rate. This is the interest rate that will be applied to your loan or credit card balance on a regular basis, often daily or monthly. This rate is calculated by dividing the annual interest rate, the one you're typically quoted, by the number of periods in the year. For instance, if your annual interest rate is 12% and interest is calculated daily, the periodic interest rate would be approximately 0.032%. This is because a year has roughly 365 days. Next, the lender uses this periodic interest rate to calculate the amount of interest that will accrue over the duration of one period on the loan or credit card balance. For example, if you have a balance of $1,000 and the periodic interest rate is 0.032%, you would accrue approximately 32 cents in interest over one day. But here's where things get interesting. The lender doesn't just calculate the interest once and be done with it. They compound it. This means that the interest accrued during one period is added to the balance, and then interest is calculated on this new higher balance during the next period. This process of compounding can occur on a daily or monthly basis, depending on the terms of your loan or credit card. The more frequently the interest is compounded, the more interest you will end up paying. So, even if two loans have the same annual interest rate, the one with daily compounding will have a higher APR than the one with monthly compounding. Finally, the lender combines all these individual bits of interest accrued over the year to determine the APR. This gives you a single annualized rate that takes into account both the interest rate and the compounding periods. Therefore, the APR you see on your credit card statement is a result of these calculations. Now, let's shift gears and talk about interest rates. Picture this. You're borrowing a book from a friend. They ask you to return it with a small token of appreciation, maybe a coffee or a candy bar. Essentially, that's what an interest rate is in the world of finance. It's the cost you pay for the privilege of borrowing money. But instead of coffee or candy, you're paying with more money. Interest rates are usually expressed as a percentage of the amount you borrow. So if you take out a $100 loan with a 5% interest rate, you'll end up paying back $105. The extra $5 is the interest. What determines the interest rate? A few factors come into play here. Firstly, the economy. In a strong economy, interest rates tend to be higher because people are more willing to borrow and spend money. In a weak economy, rates are usually lower to encourage borrowing and stimulate economic activity. Secondly, your credit score. This is a numerical snapshot of your creditworthiness. The better your credit score, the lower your interest rate tends to be. It's the lender's way of acknowledging that you're a reliable borrower. Thirdly, the type of loan. Different types of loans come with different interest rates. For instance, credit cards typically have higher interest rates than mortgages or car loans. Now, why should you care about interest rates? Well, they directly impact the total cost of your loan. The higher the interest rate, the more you'll end up paying back. That's why it's crucial to understand interest rates and shop around for the best rates before you decide to borrow. In conclusion, interest rates are the thank you gift you give to lenders for letting you borrow their money. They're determined by the economy, your credit score, and the type of loan. And they can significantly impact the total cost of your borrowing. Remember, a lower interest rate means you'll pay less to borrow money. So, what are the key takeaways here? We've journeyed through a lot today, from the basics of credit card interest to the nitty-gritty of APR, and finally to the ins and outs of interest rates. It's been quite the financial expedition, hasn't it? Let's take a moment to revisit some of the most crucial points we've covered. Firstly, APR, or annual percentage rate, is the yearly interest rate charged on unpaid credit card balances. It's the cost you pay for borrowing money, and it's a key factor in determining how much your credit card debt will grow over time. Remember, there are different types of APR, such as purchase APR, balance transfer APR, and cash advance APR, each with its own set of terms and conditions. Next, we learned about the calculation of APR. It's important to remember that APR is calculated using the daily periodic rate, which is the APR divided by the number of days in the year. This rate is applied to your credit card balance each day, causing your debt to compound over time. We then moved on to understanding interest rates. Just like APR, interest rates are a measure of the cost of borrowing money. However, they are often used in a broader context, such as in loans or investments. The key takeaway here is that a lower interest rate, or APR, means less cost for you in the long run. Now, armed with this understanding, you can make more informed financial decisions. You can choose credit cards with the best terms, manage your credit card debt effectively, and ultimately, save yourself some hard-earned money. Always remember, though, to read the fine print. Terms and conditions can vary greatly between different credit cards. What looks like a low APR might come with other costs, like high annual fees or penalty rates. With this knowledge, you're now better equipped to navigate the world of credit cards. Thanks for tuning in.